The current live trading price for Nuburu Inc. stands at exactly 0.21 USD, showing a slight upward tick of positive 0.0031 USD, which translates to a 1.47% intraday increase as of this specific moment on November 20th. At 21 cents, the vast majority of the investing world sees a penny stock that has effectively flatlined, a piece of market debris drifting toward the inevitable zero bound that claims so many small-cap technology hopefuls. The expectation when you look at a chart like this, battered, bruised, and trading for less than the cost of a postage stamp, is that the underlying business is dormant, the technology has failed, and the management team is merely arranging deck chairs on the Titanic. That is the safe consensus view that keeps institutional capital far away from this ticker. But the reality, the one that is currently being whispered about in the darker corners of high-risk trading forums and deep-value research notes, is that Nuburu is attempting one of the most aggressive and improbable pivots in the industrial sector, effectively transforming itself from a struggling component manufacturer into a vertically integrated defense technology contractor. When you see that price of 0.21 USD, you are not looking at a dead laser company. You are looking at a call option on the future of directed energy weapons and advanced aerospace manufacturing that is currently priced for bankruptcy. This disconnect between the penny stock stigma and the defense prime ambition is the entire thesis. If you are sitting at your desk with your Fidelity mobile app open, watching the bid-ask spread flicker by fractions of a cent, you are witnessing a battle for survival that is as visceral as it gets in the public markets. The intraday movement today, while seemingly small in absolute terms, represents a stabilization level that the bulls are desperately trying to defend. A drop below the 20-cent psychological barrier often triggers algorithmic sell programs that can flush a stock like this down to 10 cents in the blink of an eye. The fact that it is holding green today suggests that someone, perhaps insiders, perhaps a speculative fund, is stepping in to soak up the liquidity. This is not the kind of activity you see in a stock that has been completely abandoned. Traders using interactive broker stock trading tools to analyze the Level 2 data will likely see walls of resistance, but also iceberg orders on the bid side, hinting that the accumulation phase might be underway before the next news cycle hits. Let's talk about the core technology, because this is where the expectations versus reality dynamic is most potent. Most investors hear industrial lasers and think of barcode scanners or simple cutting tools. That is the expectation. The reality is that Nuburu owns the intellectual property for high-power blue laser technology. Why does blue matter? Physics. Standard industrial lasers use infrared light. Infrared light bounces off copper, gold, and aluminum, the exact metals that are critical for the electrification of the global economy, from EV batteries to wind turbines to aerospace components. Blue light, however, absorbs these metals 10 times more efficiently than infrared. This means Nuburu's lasers can weld copper faster, cleaner, and with defect-free precision that infrared simply cannot match. This is not a marginal improvement, it is a step change in manufacturing capability. The market has priced this company as if its tech is obsolete, yet the physics argue that it is inevitable. We must address the elephant in the room, which is the financial condition of the company. If you look at the recent earnings reports using your Schwab Intelligent Portfolios research tools, the numbers are, to put it mildly, terrifying. We have seen quarters with effectively zero revenue. We have seen cash burn rates that would make a venture capitalist wince. This is the reality that the bears are clinging to, and they are not wrong to be skeptical. The company has had to dilute shareholders aggressively to keep the lights on, which is why the stock chart looks like a ski slope from the left to the right. But here is the twist that the headline readers miss. The company has shifted strategy. They are no longer just trying to sell lasers to random factories, they are pivoting to defense tech. The recent acquisitions and partnerships, including the deals with Techne and the strategic alliance with Maddox Defense, signal a move into the drone and counter-drone space. They are looking to integrate their blue lasers into systems that can disable unmanned aerial vehicles or facilitate rapid repair of military equipment in the field. This pivot changes the valuation framework entirely. An industrial equipment supplier is valued on EBITDA multiples. A defense technology developer is valued on contract potential and strategic relevance. By moving into the defense sector, Nuburu is attempting to unlock government funding streams that are recession-proof and significantly larger than the commercial welding market. If they can secure a program of record with the Department of Defense or a major prime contractor, the stock at 0.21 USD becomes a historical anomaly. But this is a show-me story. The market is tired of press releases. It wants to see purchase orders. Until those orders materialize, the stock will remain pinned in this volatile penny range, subject to the whims of day traders and short sellers. For those engaging in online investing through platforms like SoFi Invest, you have to understand the mechanics of listing compliance. Nuburu trades on the NYSE American, and like many stocks under $1, it faces the constant threat of delisting. They have received warnings, they have submitted plans, and they are fighting to stay compliant. This adds a layer of urgency to the trade. They can't afford to let the stock drift for another year. They need a catalyst now. This urgency often forces management teams to be aggressive, releasing news, seeking mergers, or finding strategic investors. This creates a fertile environment for volatility. A single announcement regarding a compliance milestone can send the stock up 50% intraday, as the delisting discount is temporarily removed. Conversely, a rejection by the exchange could send it to the pink sheets, where liquidity dries up. I want to pause here and ask you to engage with this high-stakes scenario. Comment below if you believe the blue laser technology is a buyout target for a larger defense prime, like Lockheed or Northrop, or if you think this is just another tech science project destined for bankruptcy. Let's hear your take. Analyzing the volume profile over the last few weeks, we see sporadic spikes that coincide with their strategic updates. This indicates that there is a dedicated group of watchers who are buying the news. However, the follow-through has been weak. This is characteristic of a bear market trap where pop-ups are sold into by trapped holders looking to exit. For a sustained reversal, we need to see a high-volume breakout above the 25 or 30 cent level, accompanied by fundamental news that validates the revenue model. Without that, the 0.21 USD price is just a resting point on a downward trajectory. Investors using Fidelity brokerage accounts to trade this should be using limit orders. Market orders in a low-liquidity penny stock can get you filled at terrible prices. The relationship with Tecne is particularly interesting. Tecne is an Italian company with deep roots in defense and security electronics. By partnering with and acquiring stakes in such entities, Nuburu is effectively outsourcing its commercialization problem. Instead of building a sales force from scratch to sell lasers, they're bolting their tech onto existing defense platforms that already have customers. This is a capital-efficient way to grow, but it adds complexity. Now investors have to parse through international joint venture structures, currency risks, and the geopolitical nuances of selling defense tech across borders. It turns a simple story into a complex puzzle, which is often why retail investors shy away. Complexity is the enemy of the casual trader, but the friend of the deep dive analyst. Let's look at the macro tailwinds. The world is rearming. Defense budgets are rising globally. The demand for directed energy systems, lasers that can shoot down drones, is at an all-time high because traditional missiles are too expensive to use against cheap commercial drones. A $2 million missile to shoot down a $500 drone is bad economics. A $10 laser shot is the solution. Nuburu's blue laser technology has inherent advantages in beam density and power efficiency that could make it a contender in this space. If they can prove that their laser is the most efficient way to neutralize a drone swarm, the valuation cap is non-existent. But again, if is the most dangerous word in finance. Currently, they are a welding company trying to become a weapon company. That transition is fraught with technical and regulatory peril. For the self-investing crowd using Robinhood app or Robinhood crypto accounts to speculate on high beta assets, Nuburu fits the profile of a lotto ticket. The correlation with the broader market is low. It doesn't matter what the S&P 500 does today. Nuburu moves on Nuburu news. This lack of correlation can be valuable in a portfolio, but only if the position size is managed strictly. You do not put your rent money on a 20-cent stock with a history of net losses. You put the money you would otherwise spend on a weekend trip, fully accepting that it might be gone by Monday, but with the hope that it pays for a new car by next year. We also need to discuss the going concern language in their filings. The auditors have explicitly stated that there is substantial doubt about the company's ability to continue. This is standard for pre-revenue or low-revenue biotech and deep tech firms, but it scares away the Fidelity wealth management types. It means the company is on a lifeline. They need cash. They raised some recently, but in the hardware business, cash evaporates.